Good afternoon and welcome to Airmic's first in a series of webinars on digital transformation. My name is Kim Lee and I am Research and Development Manager here at Airmic, and I'll be setting the stage for today's webinar. I'd like to introduce our speakers for the day, Phil Wheeler and Paul Jones. From AXA Corporate Solutions. They will be speaking about a new piece of research: is the insurance market fit for the future? Last week, Julia Graham presented the results from our survey report, A Profession in Transformation, and the results from that piece of research is on your screens now. On the back of that survey, we produced 3 deep dive reports that focused on specific cuts of data. Today's presentation will focus on one of those reports: is the insurance market fit for the future? Before I pass over to our presenters for the day, I have a few housekeeping announcements to make. As ever with our webinars, this is an interactive session and we encourage you to ask as many questions as possible. You can do that via our GoToWebinar control panel, which is on the right of your screen and looks something like this. To ask a question, scroll down to the Questions tab, type in your question in the allocated box and then click Send Privately, and we'll pose your questions towards the end of the presentation. This slide deck is available for you to download in the Handouts tab, as well as the mini report, Is the Insurance Market Fit for the Future? That is all from me for now. I will now hand over to our presenters.
Thanks, Kim. So the purpose of today's webinar is to give people who are unable to attend the seminar at the Airmic the opportunity to review the content of the Fit for the Future report, which was undertaken after recognising a change in the modern business landscape and asking the question of whether the conventional insurance models are keeping up with the change. There would also be a chance to hear from myself and Paul later on in the presentation about from the insurance perspective, as well as touch on some of the areas where insurance companies are investing in innovation.
So, looking at the evolving risk landscape, according to the report, 74% agree risk management needs to evolve to meet future challenges. The challenges that have been identified as two of the highest threats are changes in operational threat and intangible risk. 82% of risk managers believe that their internal value will increase in their business over the next 3 years, with a significant proportion believing changes required to cope with the increasing complexity of risk, the pace in which that risk is changing, and how reputation can be affected as a result. With 84% of the S&P 500's value being held in intangible assets, we have to raise these issues to the top of our agenda when there is a need to mitigate risk in the first instance and transfer it in the second instance. NatCat, BI, fire and explosion, while still high concerns, are much lower concerns than reputational or cyber risk. Much of that is a complete shift from a decade ago. New technology, such as AI in business, is considered as an increasing risk over the next 3 years. And whilst we believe this could significantly impact reputational risk over the same period, risk managers see this risk reducing.
Now this graph shows the response to a question of how risk and insurance managers plan to mitigate some of the emerging risks identified by Paul in the previous slide. It's no surprise to see that there is an expectation that each of the risks will be reduced by effective management, with the greatest levels of mitigation being seen within the management of new business models. The interesting thing that this graph is showing is around the appetite for retaining risk versus transferring risks externally. The area that stands out is in relation to the loss of data following a cyber incident, where there is a clear appetite to transfer the risk externally rather than retain it within the business. Now, this could be for a number of reasons, but my view is that this is most likely a combination of the exposure becoming more high profile following recent events and a greater understanding of the risk transfer product being offered. For me, it would be interesting to have seen how this question would have been answered if it was 3 years ago, and then compare that to the answers now, just to see how the responses would have differed in a relatively short space of time. It is also clear that with exposures like brand damage, new business models, and to a lesser extent intangible risks, there's much less of an appetite to transfer these externally. One of the common aspects applying to each of these is that exposures are very difficult to quantify, which when combined with the lack of historical data makes modelling and pricing of them very difficult. In line with what is happening with cyber insurance, or what has happened with cyber insurance, it would be interesting to see whether the insurance market is able to produce products and services that will increase the appetite to transfer some of these risks in the future. This next diagram is highlighting the capability and resource to respond to the same 4 risks that were identified in the previous slide. The statistics are calculated on a net balance on whether respondents either had a positive or negative view. So using new business models as an example, there were 43% positive and 46% negative responses, giving the net position of -3. So what this shows is that a greater number of the respondents are more comfortable managing brand damage and cyber risks. This could be down to the fact that these losses have the potential to be triggered by a wide range of risks, a number of which are more established, such as business interruption, supply chain, and natural catastrophe. These results also align with the previous slide's results, especially in relation to brand damage, where there is a greater expectation to manage and retain these risks internally within the business. On the other end of the scale, new business models and risks to intangible assets have prompted a greater level of negative responses, which clearly identify them as areas in which greater support and resource is needed.
So the most significant shift that risk managers want to see over the next 3 years, according to this information, are added value solutions or insurance bundled solutions from their insurers. It seems a key area for this is data and analytics, and that risk managers will focus on what their data is telling them to make or be involved in key business decisions, which pages 12 and 13 of the mini report focus on. As risk management becomes increasingly important in the business, budget and data quality should also improve to support that process. But until that's embedded in the risk management function, insurers and brokers can assist in that process.
So the report we've just discussed has been based on the views of risk managers and insurance buyers. So in the interest of fairness, we wanted to provide some insight into an insurer's view of the current market before discussing in greater detail where insurance companies are innovating. Now, from an insurer's perspective, it does seem that there is always an interest from buyers in new products and services, but a lot of the time this interest doesn't actually translate into final sales. Now, this could be for a number of reasons, including the offering not covering the risks required, the cost being too expensive, or most likely a combination of the two. But what it does mean is that there is currently a disconnect between what is required and what is being offered. All this means is that right now insurers are most likely to focus on growing their established products and services rather than in innovation. Now, service capabilities of the main global insurance companies are very similar, with most being able to offer a core level of additional services, for example, a wide network capability, risk engineering, and claims handling. This means that in a large number of cases, the differentiator in determining which insurer or broker to partner with still comes down to price. And this can result in an adversarial relationship in the market. Now, believe it or not, commercial insurance lines operate on very tight margin ratios. Therefore, there is not a huge amount of capital to be spent in areas that do not offer a return on the investment in a relatively short period of time. Now, you could say that this is being short-sighted, but in the current economy, I believe that most businesses would have a lot of difficulty in agreeing in investment for areas where there is not a high likelihood of getting return on that investment. So now to the question about whether the insurance market is ready for the future. I think we can safely say that there is still a lot of work that needs to be done before we can suggest that the market is ready for whatever the future brings. There is still a clear disconnect between what the risk and insurance management community is looking for and what the majority of major insurers are able to offer. Now, rather than just say no to this question, I wanted to say it's a work in progress, as there is recognition from insurers that they need to adapt and take a number of steps in the right direction in order to be successful. There needs to be a greater level of collaboration between insurers, brokers, and clients. Insurers need to embrace technology to provide services that clients are looking for and make the most of their capabilities in areas like data analytics, where there may be a shortfall in the expertise and resource from within a client's business.
So just as an example of how we are investing, and not just AXA, but the insurance market as a whole, 20 billion euros was invested in insurtech startups or current projects during 2016 alone. This is an example on screen of an insurtech ecosystem that AXA have started, from build, invest to partner, and from idea to grow to partner. This isn't too dissimilar from other insurers' ecosystems for tech startup. All of this is done to disrupt the conventional cycle and look at innovative ways of adding value to our clients and their businesses.
So the types of insurtech in which companies are investing generally fall into 4 key areas. We've got connected health, which is the management and delivery of healthcare services using remote technology. We've got big data, which is basically processing large amounts or complex information and then using predictive analytics or other advanced analytical methods to extract value from that data. We've got user interface, which is essentially managing the interactions between users and machines and to produce the optimum output, which is enjoyable and easy to use. And then finally, you've got artificial intelligence. Now, I've left this until the last because I wanted to touch on this in a little bit more detail and give you an actual example of an insurtech company that AXA has invested in. BioBeats is a digital health and artificial intelligence business that specializes in providing wellness solutions through technology. As with most types of these products, the initial application was intended for use by individuals. However, one of the interesting things about this business is that they're developing a corporate solution to help employees control their own wellness through the use of wearables and data-driven coaching. This is a good example of how the innovations that are made in the private insurance sector have the potential to be used in the corporate arena, with options for innovative solutions being bundled alongside more traditional insurance products like employer's liability.
So if we're looking at new products and new solutions, we also need to look at the people that are able to deliver those solutions to our customers. Carlos de Stella is one of our data scientists at AXA Lab in Brazil. Carlos and his team are currently looking at applying algorithms to claims information to detect fraud. And whilst this project is heavily data-driven, it's also using voice recognition to detect variation in vocal sound to detect fraud also. We must get the right people in place to support the added value services and bundle services that risk managers want from their insurers. An example of innovation in practice at AXA is parametric insurance. Weather protection has been a long-established cover, but the data now available for parametric covers gives risk managers the opportunity to protect against the most unique events. Index insurance is flexible, and in the event of a loss, payment is issued within a few days. Big data sets coupled with the latest technology give us the unique ability to give risk mitigation advice and risk transfer solutions that are needed. Parametric insurance has developed further from rain and temperature to more creative solutions such as burnt area indexing and soil moisture indexing, and we can use the latest satellite technology in deriving any index for businesses.
So just to summarise, I think we're all in agreement that there is a significant need for change within the risk management profession, and insurers need to be able to adapt their service solutions to help with this change. And to facilitate it, we need to adopt a more collaborative approach between insurers, brokers and clients rather than the existing combative framework. And a greater level of dialogue between insurers and clients needs to be in place to ensure that where investment is being made in the right areas. And finally, it's just to reiterate that there is investment being made by insurers. But unless we're able to pinpoint a commercial product that works to provide a clear benefit to the clients and is financially viable for insurers, this investment will still be focused in areas where there is a greater chance of making a return, which is currently in the private lines markets.
Paul, Phil, thank you very much. We do have a few questions that have stacked up here from the audience, so I'll just take them one by one. The first question, I suppose, relates to the management of intangible risks, and I'll just take us back slightly to some of the stats that are kind of outlined in our mini report. A reputational risk comes out as the top risk, unsurprisingly, and about 51% of our members have indicated that this is the risk that keeps them up at night. But of course, there doesn't appear to be an insurance solution for that. So what can the insurance market do, if anything, to help members who are struggling to sleep because of this risk?
That's an interesting question, and I think that whilst there isn't a solution in the market, there are mitigation functions you can look at and support that you can get from your insurer. So whether that be, you know, supporting with their social media policy internally, whether that be giving advice on what to do in the event price immediate incident. Ones recently for people being dragged off planes, etc., that can escalate quickly and then really damage a company's share price. So I think, you know, it comes back to what controls are in place, and that it is a mitigation function and a business risk, perhaps more so than a risk transfer option in the market. But again, to get the support of your insurer, involve them in the conversations around sort of social media policy, good governance around you know, who their spokespeople are, etc., for that particular example.
I think, just to reiterate as well, we're coming in with looking for a solution just to a question that has just been raised is quite difficult, because until it's really understood from within the business what help is needed and what exposures the business has, it's very difficult for an insurance company to then be able to come in and go, here's the solution for you. You first have to understand what it is that you want help with.
Yeah, I guess it always starts from understanding and learning more about the risk.
And then communicating that to...
Yeah, absolutely. And I think that's a very interesting point, because our survey reflects that. I mean, one of the findings was that only 3% would look to the insurance market would transfer any risks related to reputational damage to the insurance market. So that's a small percentage, that's 3%.
And I don't think that there's products available, and if there is a product that would cover that, it would be expensive, because, as I touched on within the report, there's not sufficient information at the moment to model those kind of exposures. And so when that's the case, someone who's putting up their capacity will want a greater premium for that capacity, because they don't fully understand their exposure to loss.
It's interesting, because then we also have the percentages that suggest that what members really want to do is retain the risk and reduce it, and we're coming up to 46% saying that they would, that they're looking to reduce their reputational risk, and 48% saying that they would retain it. And I guess the bundled solutions, or the value-added solutions that you had mentioned earlier, Paul, are the sorts of things that can help members.
Yeah, and I think that that's where they, members should sit down with their insurers on some of their bigger lines, perhaps bigger premium spend lines, and ask for support in their business function as well.
Brilliant, thank you. We do have another question here about collaboration. Now, I guess it's the sort of message that members hear often. If you want support from the market, collaboration is the way forward. Speak to your insurer, speak to your broker, and then together would come to a solution. But how would you describe that sort of relationship at the moment, and where does it need to improve? So the relationship between the insurer and the risk manager at the moment, and where does it need? How can it improve?
Well, first of all, there's the combative relationship at the moment. We all know that on a number of lines, the market is soft at the moment, and all companies are having challenges in financial spend and getting their balance sheets to, or getting their insurance spend down. And so that whole economy within the insurance industry is making the price the key factor, and it's when we're able to produce, it's when we get out of that price-driven discussion that you find that the most value is found, because when you're having discussions around how you can actually help a client run their business, mitigate risk, that's when it's something that insurers want to get involved in, because that builds up proper relationships with both brokers and clients that are much more long-term in nature. And so that's where we want to be, because when in the current climate where it's very much along the lines of a price-driven discussion, there's very little room in there for talking about the value-added services that insurers can provide. And we need to be better at communicating what we can do, but we also need to have the buy-in from the insurance buyers and the brokers to make sure that when we are investing additional time and our own intellectual property with the client, that it's not going to leave, or that client's not going to leave because we're 2-3% more expensive.
Absolutely. So in other words, it's a very transactions-driven model at the moment, and that's what needs to change. Paul, were you going to?
I think there's also a question of time availability from the client's perspective. You know, clients obviously have a huge amount of things to do in terms of managing the risk within their business. So how much time have they actually got to sit down with not just one insurer, but maybe 2 or 3 insurers, get them around the table and say, actually, these are the things that we can't transfer, but we want your help with. So I think that, yes, there is a price sensitive issue going on at the moment. And to be honest, that is likely to be the case for some time. But coupled with that is actually how much time and resource can we all dedicate to this? And we're at risk of not actually putting enough time into those relationships and into those services to maximise the benefit for the members.
Absolutely. And Paul, you mentioned sitting down with 2 or 3 insurers. This is 2 or 3 competing insurers.
Yeah. Because I don't think that necessarily when we're talking about, when we're not talking about competition around a certain subject, if we're talking about just giving advice or just giving support, then unfortunately right now the market's not very good at collaborating. We're sort of sat within our own companies, and really we should be a lot more open-minded about the value that perhaps sitting down together to support non-tangible risks or reputational risks, or think, you know, we should work more closely perhaps if a client's got a different property, casualty and motor carrier or marine, to sit down with those 3 or 4 markets as their partner markets and say, actually, you know what, this is what we can do.
Absolutely. It's not a risk that can be tackled by one insurer. It is a whole market sort of it is collaboration that's needed to overcome this, isn't it?
Yeah, and getting that scenario sorted, that comes down to the client. You know, to get the client to get those insurers to come together, because we're not going to reach out to our competitors necessarily to talk about a specific client. You know, we need that to come the other way.
So perhaps we need a working group. Perhaps we need to pull in all the insurers and the brokers.
I'll leave that to Airmic. Leave that to Airmic.
That's a discussion for another time. I do have one other question here. I think we've got time just to squeeze in one other. There were some slides there that looked at innovation in personal lines, and I found the parametric slide very interesting. How do you see innovation from personal lines manifest in commercial lines? So how can some of that?
Well, I think if you take parametric as an example, I know Phil's got the example with BioBeats, but I think with parametric, you know, for a long time people have been covering small events, like, you know, people would buy wedding insurance that would have some weather thrown in there, small events insurance with some, you know, weather risk thrown in there. But, you know, from the data around that, you can actually then build much larger data sets to ensure, you know, whole plantations of crops across Africa. And this is the sort of stuff that, you know, has developed from the idea of weather risk from an event or from a personal lines function. So that's one example. Obviously we've got BioBeats, but
well, I think that a lot of the innovation that's in the personal lines at the moment is around technology and what you can do with your smartphones and your computers nowadays. But when you look at commercial insurance, we're still talking about sprinkler systems and burglar alarms and things like that. So I think that there is going to be a point where the new technology transfers into the commercial side of things, so that there could be the situation where you have an insurer who, as well as just providing insurance, also provides the software that links all the fire alarms within a building, and they monitor them so they can look at heat. There's a lot of innovation that's going on at the moment that, if you just take it that one step further, could have a commercial impact. But we need to, I think a lot of these products are in they're in the development phase on the personal lines, and I think that it will take a little bit more time before they get that right to then transfer it to more of a mass user interface.
So I guess it's watch this space.
It's watch this space, but equally I would also say there are things out there now. You know, you look at smart workstations, you know, where actually you don't have keyboards or mouses anymore that can create RSI injuries, you know, but actually smart workstations where you don't have anything on them other than the ability to see visuals. So it's when we get to a point where investment in this makes it cheaper from a business perspective that will also help manage risk amongst corporates. So it's a bit of a catch-22 sometimes. Yeah.
Well, the future does sound very interesting indeed. That brings us to the end of today's webinar. Paul, Phil, thank you very much for your insights.
Thank you.
This webinar will be available on the Airmic website to download, as will the report. The website address is on your screens now. The next webinar is Digital Transformation and the Impact on Risk Managers, and that will be presented by Kyle Bryant, who is the Regional Manager Cyber for Chubb, and that takes place next Thursday at 3 o'clock, to be followed by The Value of Risk and Insurance Management, presented by Hamish Roberts and Adrian Donald from JLT. To register, please follow the link on the slides. We hope to see you next week. Thank you.